Okay, forward market hedging is something we mentioned before, and it is easier to understand than option hedging. So if you have receivables invoiced in foreign currencies, you should sell the forward because after you receive the foreign currency, you will sell it for US dollars. And you need to sign a forward contract that will obligate you to sell at a specific price in the future. Okay, so I highlight the keywords in red color so you can memorize it better. So let me repeat the statement. The firm sell foreign exchange forward to hedge the risk in foreign currency receivables. And if you have a foreign currency payables, then you will need to buy those forwards. Okay, so when you need to pay the bill in foreign currencies, of course, you need to use US dollars to buy those foreign currencies to pay your foreign partners. So you need to sign a forward contract in which you're gonna buy those currencies. Okay, so the story here is today you sign a forward contract. When the receivable is due, you will receive the foreign currency and then sell at the forward rate. And today you sign a forward contract as well. If you have payables, when that payable is due, you're gonna buy the foreign currency and the forward rate to pay the bill. All right. So here is a chart I make to show you there could be some downside and some advantage for using the forward to hedge the foreign exchange receivable. So this chart is a downward sloping curve. Okay, sorry, it's an upward sloping curve. So what it shows here is if you have, let's say, 10 million pounds to receive, and if you sign a forward at a rate of 1.46, then that 10 million pounds will be 14.6 million US dollars, no matter the spot rate goes very low or goes very high. All right, so this is a hedged position. You use a forward contract to hedge it. And if you don't hedge it at all, if the spot rate goes very low, let's say go to zero, for the 10 million pounds, you basically get a 10 million times zero, so you get a $0. And if the spot rate goes very high, then for the 10 million pounds, you will get more than the forward rate for the US dollars. Okay, so if you compare the spot rate and the forward rate, and there could be some gains and some losses. So if the spot rate goes very low to a zero, between receiving zero and receiving $14.6 million, so definitely $14.6 million is better. So you are essentially better off by that amount. And if the spot rate gets higher and higher, then if you don't hedge it, then you will receive more and more US dollars for the same 10 million pounds. Then the gap between your forward receivable, which is 14.6 million, and the US dollar you actually receive from the spot market is actually getting smaller and smaller. And when the spot rate goes very high, that means you are better if you don't hedge the position. You're better if you just go with the spot rate, which is a high rate. Okay, we're talking about this zone here. The spot rate is high. Then if you hedge, then you are basically worse off, because if you hedge, you only get a $14.6 million. If you don't hedge, you just go with a higher spot rate. You are better off. So essentially, the forward contract make you worse, and this is a loss for you. So that's why I call this chart the relative gains and losses for selling foreign exchange forward to hedge foreign exchange receivable. Okay, it is a relative gain or loss, because if you do a forward hedging, you just receive a $14.6 million sharp, regardless of the situations. However, you would be worse off. You would be better off if the spot rate goes very low. You would be worse off if spot rate goes very high when you don't hedge the compared to the situation you don't hedge. All right, here is a hedging example. So you have well, once again, this is a Boeing company exported a Boeing aircraft, and then they will receive a 10 million um, British pound. So you are dealing with foreign receivables. You should immediately tell that your transaction should be sell forward. Okay, you should sell forward. So after you receive the 10 million pounds from British Airway, you will immediately sell it using the forward contract, and the forward rate is 1.46 million. So no matter what your position is, if you don't hedge, no matter what the spot rate it is, you always receive 14.6 million US dollars for the forward position. Okay, so if the spot rate goes low to 1.3 or goes high to 1.6, you always receive a 14.6 million US dollars. But if you don't hedge at all, if spot rate is 1.3, then you will receive a 13 million dollars for the 10 million pounds. If spot rate is 1.6, you would receive a 16 million dollars for the 10 million pounds. If you do a subtraction, then you will see that if a spot rate goes low, you are relatively better off from a hedge. The difference is the money you make from hedging minus the money you make from the unhedged position. Okay, so if the spot rate goes high, I mean higher than your forward rate, then you are worse off by signing yourself into a forward contract. Then hedging is not provide you any benefit, but incur some relative loss compared to the case you don't hedge at all. So right here you see a survey of the managers in the Fortune 500 firms back in 1995. I know the year is pretty early, but that's the latest we can get. So this survey is telling us that for all of these financial products those companies use to hedge their foreign exchange risk, on the top of the list is the forward contracts. So 100% of them have heard of that, they're aware of that, and over 90% of them have actually used a forward contract to hedge the risk. And on the second of the list are currency swaps, and also followed by currency futures. Most of them have heard about that. 20% of them have used the futures. Forwards and futures serve the same purpose because it's about signing an obligation to buy or sell foreign currency at a predetermined price, but futures are more standardized to trade. And they have also heard and used currency options, futures options, and some of the options are traded in exchange floor, and some of them are traded over the counter. So those options also have a wide usage. And there are also cylinder options, something we learned earlier in the late part of the option chapter, and also synthetic forward, synthetic options. Synthetic basically means combinations. Okay, so now I highlighted those ones that are heavily used. And for currency swap mentioned in that survey, the structure is pretty easy to understand, and there's are not a lot of computational problems or questions I can develop based on this topic. You just need to understand the whole structure of it. So let's see. We have two companies. One is an American company. Let's say this is a American company called Miller, and there's also a German company called Beck. All right. So the American company have European operations, and they would receive euros from their European subsidiaries. And this German company have U.S. operations, and then they receive U.S. dollars from their American business. So for each of the company, they have to deal with their investors in their home country. So for Miller, they have to pay money to their investors in U.S. dollars, and for Beck, they have to pay their investors in euros. All right. So if they just operate separately, Miller has to convert euros to dollars, and the Beck has to convert dollar to euros. Okay, they both have to do that conversion. They both have to pay transaction fee to a bank, and they both have to suffer the risk or uncertainty of the exchange rates. So if euro depreciates, so who is better off? If euro depreciates, then um, the dollar gets stronger. So for the same dollar received, the that company would get more euros. Okay, for the same dollar they receive, because euro depreciate, the same dollar can exchange for more euros. So back investor would be happy. But a Miller's investor would not be happy when euro depreciates. The same amount of euro receive would be exchanged for less dollars. So the American investors of a Miller would not be happy. Okay, so if euro appreciate, then you will see that American investors of Miller would be happy because same amount of euro would get more dollars for them, and the German investor of a bag would not be happy because for the same amount of dollar, when euro appreciates, they would get less euros. So, well, true that if the currency, if euro goes up, one is happy, one is sad. If euro goes down, the other is happy, then the opposite is sad. But they both hate risk, okay? They both hate uncertainty because none of them can control the future exchange rate. So here comes to the currency swap. So they make agreement among themselves, and in this agreement, they decide a fixed exchange rate that will happen for the next 5 years, or maybe less, or maybe more. For the certain amount of periods, they would exchange cash flows with a predetermined exchange rates. So they don't have to be exposed to the appreciation or depreciation of euros. They don't have to deal with a bank which charge them a transaction fee to do the exchange. So they just deal with themselves. So in this currency swap, when the German company receive dollars from its American business, then the dollar will be directed. Okay, those dollars will be paid to Miller Company, and then Miller Company will use the dollar to pay its shareholders in America. Okay, no exchange ever happened. And when the American company receive euros from its European operation, then these euros will be paid to a back company, the German company, which will be paid to their German investors. Okay, so there's no exchange with the banks, but there would be exchange with themselves. So that's how the currency swap comes to place. As I said, there's no numerical questions I can develop out of this, but there is a case study based on the currency swap signed between the Greek government and the Goldman Sachs. And in this question, which is in your second homework, you need to read some materials. You will need to do your own research, browse the internet, and get some articles which describe the nature of the currency swap between the Greek government and the Goldman Sachs, which is a American Wall Street firm. And some blame that the currency swap lead Greece into its debt crisis in 2010. And please find more about that currency swap. In particular, what are the terms and why the currency swap would qualify Greece into the eurozone, and then later it exploded and forced the Greek government paying more euros to Goldman Sachs. Okay, so that's a homework question for you to do some research on. Okay. Oh, back to the currency swap. I have an interesting example. All right, my parents are in China, and sometimes they visit me in the United States, and sometimes I visit my parents in China. So if my parents come to the U.S., they have to convert Chinese yuan to U.S. dollar. If I go to China, I have to convert my saver salary, which is in U.S. dollar, to Chinese yuan. All right, so we both have to do the exchange and to pay the banks some transaction fees. So that's the situation without currency swap. So in this background, I and my parents, as two parties, can sign a currency swap agreement. So my parents would give me their pension money in Chinese yuan, all right, and then I would give them uh, my St. Xavier salary, part of it, of course, in U.S. dollar. Okay, so when I go to China, I spend their pension money in Chinese yuan, and when they come to the United States, they spend part of my St. Xavier salary. Okay, and of course, when we can determine the exchange rates based on who have more negotiation power, and also we don't have to deal with the Bank of China and Bank of America to avoid paying the transaction fee. Okay, so this is just an analogy of a currency swap, which is indeed a currency swap between some individuals.